All right, today we have a stock analysis of one of the most recognizable brands on the globe, and that is Coca-Cola. So we're going to take a look at the business, look at the fundamentals, look under the hood, and see if this business is a great investment. And we're going to talk about where this possibly can fit in your portfolio when we get done with the analysis. So let's get right into it. We have Coca-Cola Company, ticker symbol KO. So as you see over the past 5 years, we have a 43.6% total growth rate. So they're growing at about 8 to 9% per year. Not very strong growth just compared to some of the high risers, but stable growth. This is something that if you invest in, you're not worried about volatility. You're not worried about the stock dropping out of nowhere or over bad news. It's going to be stable. So that everybody who invests in this company and everybody around the world believes in this company because it's such a strong brand, one of the strongest really ever created. So let's look into this stock. Look at the all-time chart just to see how this stock behaves. I'm not a big charting guy. However, I do like to look at a stock to see how it's behaved over the years. So we have a sharp increase here. We have the 10 years of the lost decade, and then we have steady growth. So small dips, very insignificant, but we have steady growth going up all the way until now. So this is a definite, stable, growing company. Not high growth because it's a very mature company in a very mature industry. Anywhere where beverages can be sold, Coca-Cola is there. They are top of the mountain, king of the mountain. Whenever there's more share to go get, they are likely to get it. They can acquire other businesses, and they have the capital to be the first in the market. When some of these developing countries get running water, start getting different distribution channels and supermarkets, Coca-Cola is one of those companies that is definitely going to be there. So this is why we have this company that is just pretty much as big as they can be and continue to growing at a pretty steady 8 to 9% growth rate per year. And that's not including this 2.9% dividend. So with that together, you got about 11, almost 12% of stable growth throughout the decade. So we like to see that. Let's get into the analysis. Going straight to the revenue and margin trends. So looking at revenues first, 2015, 44.2 billion, all the way to 2024, 47 billion. So this is not strong, large growth overall. Notice that they started in 44, and then they had some negative years, and then they were in the 30s all the way down to 33, back up to 47. So higher than what they were a decade ago, but not much higher because they did have a dip. And this is something that you can expect from these mature companies. They're not going to grow and knock it out the park with growing revenues every year because that's not the stage of business that they're in. It's not the life cycle of the business. However, we do have some growth there. So 5.2% growth, compound annual growth over the past 5 years. Let's look at gross profit. Now we pay attention to the percentage here more than anything. We have 60.5% down to 59, but back up to 61%. So we expect to see something like this when it comes to these mature and stable companies. You want to see strong margins, and you want to see consistent margins more than anything, and possible growing margins. But we see that 60% is where they've been pretty much holding at. Solid margins there. And we like to see it consistent. Now, looking at the profit, 7.3%, 16.6% net income ratio to 10.6, 22%. So this is great to see. And you do see this in mature companies where revenues may not be growing at the very high rate, I should say, but profit is steady going up because as the business matures, as they take advantages of economies of scale and they become more efficient, they can keep more of that every dollar that comes into the business. So for every dollar, they went from holding 16.6 cents to 22 cents on every dollar that came in through their business. So increased margins is what we like to see when it comes to mature businesses. You're not going to necessarily see a lot of outstanding results on the top line revenue, but we want to see strong gross margins and we want to see growing profit margins. So that looks good for Coca-Cola. Now looking at the free cash flow, looking at the cash that they generate from operations, and after they take care of their capital expenditures, the required reinvestment for them to stay open, what's left over? So first, let's look at how many negative years they have. We got 1, 2, 3, 4, 5. So half of the last decade, cash flow has been down. Let's look at the peak in 2021 at 11.2 billion, 9.5, 9.7, and down to 4.7. Now, this is interesting here because whenever you see these large drop-offs, especially from a company like Coca-Cola that's mature, that you would expect consistent cash flow every year, you got to look at what's going on. So they had about a $6 billion IRS tax payment due to some litigation that they have. So it's a one-time significant expense. Without that, I believe cash flow would have been around 10 billion. So they would have been trending up, but they had to make this tax payment this year, which knocked cash flow down to 4.7. So looking at that, we can understand that this is an anomaly. This is not a consistent, it shouldn't be a consistent trend of cash flow going down. Next year, it should pop right back up, but we'll see what happens. We got to keep an eye on it to see where it ends up, but we should not expect this to be a sign of what's to come in the future concerning their cash flow. So moving on to debt. How much debt are they holding compared to their cash flow? Let's see what we're looking at. 2015, 28.3 million, 2024, 43.2. So we see that it went up to 41, dropped down a little bit. Now it's back up to 43. And because that cash flow did drop down, they're not in a very healthy position when it comes to the debt to free cash flow. We like to see companies with below 5 years, if possible, below 3 years. That's really a sweet spot. But we will accept 5 depending on the business model of the business and the stage of the business. And right now they're at 9.1. So over the past 3 and 5 years, they have averaged below 5 with this 4.8 and 4.5. So they're good leverage position on average. Is just right now with that anomaly of IRS tax payment, they're in pretty bad position, but they should be able to rebound within the next fiscal year and be in much better position moving forward. So we're noting it. That shouldn't scare you away as an investor, but we are noticing it. Now, let's look at this visual of comparing the debt to free cash flow. So the orange represents the debt and the green is the free cash flow. Now, what we don't like to see is how the debt is trending at a much higher rate than their free cash flow. So over the years, they're kind of trending in the wrong direction as far as their position of leverage. We do understand that this year, 2024, has a lot to do with it. But even if they didn't have the IRS tax payment, they'd probably be right about here at the best. So this green line would be trending up more, but still wouldn't be trending as high as the long-term debt. So this is something that I would not expect to see from them, but I don't know exactly what they are seeing coming forward. I know they had a tax payment that they, or not a tax payment, excuse me, a payment that they had to make this year in 25 for an acquisition that they made a few years back. It was more of a contingent payment. It was about 5 to 6 billion. So they could be bringing in on some debt just to finance some of these contingent payments, and they'll pay it off in the future with the future cash flows. But again, not something that is alarming at this point, but it's something to note. Now, what do people love about Coca-Cola? They love the dividend. They've been growing their dividend every year for, I want to say, over 40 years, if I'm not mistaken, at least since the 80s. I'm pretty sure of that. Current dividend yield, we're about that 2.8, 2.9%. Expected dividend per share, they're paying 51 cents per quarter. And right now, the payout ratio is 176%. So when I look at the payout ratio, I'm looking at the free cash flow and how much of that is being paid out in the dividend. This year, it's so high because we talked about that IRS tax payment. So without that payment, they'll be much lower. They are a company that sometimes all of their free cash flow is paid out in the dividend, because if you think about when the company is deciding to pay out a dividend, or they're deciding to grow it every year, when you have enough cash to operate your business and you don't need that cash because there's not many opportunities to continue to grow and expand because you're so large and you're dominating the market, you can expect that dividend, or you could expect more of that free cash flow to be paid out to the shareholders in the dividend. So that's where Coca-Cola is right now. Them and Verizon, These are companies where 90 to 100, sometimes a little bit over 105% of their free cash flow gets paid out in the dividend. So when companies do this, of course, they have the cash balance to do it, and they have the future free cash flows to cover this dividend payment. But over the past few years, we have a 5% growth, 5.4, 4.5, 4.7, and a 2.4% growth. So they've been growing their dividend, I'd say about the average rate that companies are growing their dividend when they're in the S&P 500. So not super high growth right now, but definitely consistent incremental growth. And this is one of those businesses that people love because the dividend's coming and you can reinvest those dividends, buy more shares, get more dividends every quarter, and continue to compound in that way. So that 8% growth to some may look measly, but if you hold stocks like this for 10, 15 years and you're reinvesting those dividends every year, you're compounding that growth. So again, Warren Buffett bought Coke in the 80s. You see that 2.9% dividend rate right now. That's when you buy it today. Imagine if you were to buy the stock way back then and you held it over the time. When you bought stocks then, the dividend that you're receiving now is well over 75 to 80% of your cost when it came to that. So yield to cost is much more important than dividend yield. Dividend yield is talking about what you get when you buy it today. Yield to cost is what you get after you've held that stock for a long time and that dividend has grown more and more every year. That's where you have to pay attention to. You want to invest in these companies, hold them, and allow that yield to cost to grow and grow and grow. Then sooner or later, you'll have some income that you can have to pay expenses based off the dividend. So the Coca-Cola is definitely that type of company. Let's go to shares outstanding. Now, when it comes to mature companies, we like the share count to come down. However, it's going up. It's going down over the past few years, but it was going up from 2019 to 2022. Now, when mature companies are doing this, typically that is saying management believes that the stock is overvalued. And just like you as a shareholder or as an investor, you want to buy stocks when they are undervalued. When they're overvalued, that's when you want to look to sell potentially. If not, continue to hold. So when a company is looking at their shares and they're deciding whether to buy shares to increase the earnings per share and increase the value to the shareholders, or sell shares and bring in cash, even though they may be diluting the shareholders, they also, mature companies, they have to look at what's the valuation of the business. It is smart for a business to sell shares if the stock is overvalued. Now, sometimes a newer company that just needs the cash, they're not really concerned about the share price. They just need money coming in so they can continue to fund their business and keep the doors open. But when it comes to mature companies who are doing this, chances are during this time, they saw that their cash flow could increase, or I should say, they saw that their stocks were overvalued and or they wanted to fund some acquisitions to continue to grow the company. So when a company is doing this, pay attention to why they may be doing it. Companies like this typically are selling shares, as you see they're doing here, but they did have an acquisition during this time, and maybe that's why they were selling shares. So yes, you're getting diluted these years. However, if they're taking that money and they're making an acquisition and growing the value of the business, that is something that you should be able to stomach for a few years for a mature, stable, dominant company like Coca-Cola. So keep that in mind and include that in your analysis moving forward. Economic value added. So how well does the management deploy capital to earn a return, and compare that to the cost to having that capital? What is the interest on the debt and what is the opportunity cost? Because instead of putting that money into the business, they could put it into the markets. We want to know what the cost is of having that cash compared to how much they're earning on that cash when they put it into the business. So we look at return on capital and compare it to the weighted average cost of capital. Coca-Cola over the past 5 years, averaging 13.9%. Weighted cost of capital, 3.9%. So they have a spread of about 9.9% of economic value created every year by keeping their operations going. So that is a good sign. Solid spread over the cost of capital. So that's what we want to look at right now. Always be careful to not invest in businesses that are consistently losing value. They might have a profit, meaning they might have revenue and money left over, but what are their returns on capital compared to what it costs? Some companies don't have a high enough return on capital and their cost of capital is higher, meaning they may have a profit or they may bring some money in, but think about the fact that they are losing economic value. Economically, this business is getting weaker and weaker and weaker as they lose value, but Coca-Cola is not in that position. Always want to pay attention to that. Now, with that analysis done, let's look at valuation and see what we think. So this company has been growing at about 5% over the past few years. I estimate that they'll continue to grow at that 5%. 3.9% is the cost of capital. So that's their hurdle rate that they need to get over in order to produce a return to the shareholders. 9.7, this is last year's free cash flow. Remember, they had that tax payment that dropped their cash flow significantly this year. We noticed that that's not normal. So I'm going to go ahead and look at that 9.7. Again, without that, they would have been about 11% higher this year. So I believe this is conservative enough to go with last year's cash flow number. With that said, first, let me go over this. If I were to buy the stock today and sell it in 5 years, I believe I can expect about 26 times free cash flow. Right now, they're trading at about 63 times free cash flow. I think I can get it for about 26 times at least. That is the average free cash flow multiple that they've been trading at over the past 25 years. So I think that's fair. With that said, Coca-Cola is pretty much spot on their fair value based on that analysis. So they have a fair value range of $62 to $76. I believe that's the pocket of their fair value. Right now they're trading at $69.60. So this is pretty much dead smack in the middle of where their fair value is. So based on my analysis and estimate, Coca-Cola is a pretty safe investment. The volatility is very low. I believe that beta was below 0.5, which means if the market goes up 1, they go up about 50 cents. Some say that's a bad thing, but remember, volatility and risk you have to manage. So if the market goes down 1, this stock will go down 50 cents. So that is the benefit of investing in some of these lower beta defensive stocks. No matter what, people are going to drink their Coca-Cola. People are going to go to sporting events and enjoy not just the sodas, but all of their products that they have, all of their waters, sports drinks, protein shakes, everything that they own. People are going to continue to buy this product. Now, when we look at Coca-Cola and the results, you got to understand they perform well during high inflation. They perform well financially during wars, during geopolitical issues and conflicts. They've always been a consistent company, and this is why people love them for that reason. No, that's not Nvidia. It's not a high-flying stock, but we all need something like this in our portfolio to be stable and to pay out that dividend no matter what. You have to think about dividends from these types of companies as your floor. If the market goes down, if all my stocks go down, just because the stock goes down doesn't mean that the business isn't performing well and is not able to pay that dividend. The stock will drop sometimes and a company will continue to pay that dividend. That is your floor to your portfolio. And the 3% floor is a solid return. So this is one that you might want to consider just to be one of those stable investments that's going to be here 30 years from now. And you know you can pass these stocks on to your kids. So that's my thoughts on Coca-Cola. Let me know what you think in the comments, and I hope to see you in the next video.